Hello, my name is Doug Greenberg. I'm the founder and president of Pacific Northwest Advisory. Thanks for tuning in. Good news, folks. Inflation is pulling back its throttle, and there's optimism that this trend will continue. The June Consumer Price Inflation Report backs this up, with overall CPI inflation easing to 3% year over year, a considerable drop from last year's near 9% peak. This cool down is widespread, but the lowering prices for everyday necessities give a welcome relief, particularly for lower income households feeling the financial pinch. Regular unleaded gas prices are around $3.50 per gallon nationwide, down from $5, which was a record high last year. Grocery prices have held steady since last year's end, and apartment rents have plateaued since last summer. Core CPI inflation, the metric that excludes unpredictable food and energy prices, is also downshifting significantly. June saw the smallest core CPI increase since the pandemic's peak, a trend expected to continue for another month or so. Even supercore inflation, a concept popularized by Federal Reserve Chair Jerome Powell, which measures inflation for services, excluding housing and energy, is reminiscent of the low inflation we had pre-pandemic. However, not all is smooth sailing. There's a looming issue that may throw a wrench in the works for achieving the Federal Reserve's stated 2% target for inflation, a structural shortage of workers. Picture this. When the labor market lacks sufficient workers, employers often have to raise wages to attract scarce talent. Higher wages can lead to increased costs for businesses, which they may pass on to consumers through higher prices. This ripple effect can cause an upward pressure on inflation. Now, this isn't necessarily a bad thing in moderation. After all, growth in wages is generally good for workers, but it's a delicate balance to strike and could complicate the Fed's goal of maintaining inflation at around 2%. Of course, this isn't a certainty. Other factors, both domestic and international, could influence this equation. Still, the labor shortage is a factor we must keep a keen eye on, as it may play a significant role in shaping our inflation landscape moving forward. There's a key question on everyone's lips these days. Will we experience a soft landing without a recession, or are we heading towards a recession down the road? Current economic forecasts don't paint a rosy picture, with projections of just a bit over 1% growth this year, even less than last year. But crucially, they don't predict a recession. Interestingly, the bond market seems to be betting on inflation being a touch lower than economists predict. Unemployment is also expected to rise slightly, but nothing drastic. So, will we have a soft landing or not? Does it matter if the economy grows by plus or minus 1%? My view is not really. The odds seem to point to either a period of very modest, muted growth for several quarters, or possibly a very shallow recession. An interesting shift came to light at the latest Fed press conference. Their economic team, which had been forecasting a recession as recently as March, following the failure of several regional banks, has now changed their tune. They're predicting a noticeable slowdown in growth starting later this year, rather than a full-blown recession. That's a significant shift, and I believe it supports the ongoing bull market in stocks. However, this view seems at odds with the bond market's prediction, which, with its yield curve inversion unseen in decades, seems to hint at a recession. Or does it? I posit that the drop in long-term rates causing the yield curve inversion may be more about investors forecasting much lower inflation in the long run rather than a looming recession. This perspective aligns nicely with consumer sentiment and how investors are currently allocating their capital. In a promising sign, the Conference Board's Consumer Confidence Index reached a 2-year peak at 117 in July. Encouragingly, this surge in confidence wasn't limited to a specific demographic. It cut across all age groups and was evident among those earning less than $50,000 per year and those earning more than $100,000 a year. It's difficult to imagine a scenario where such widespread optimism doesn't equate to good news. Given this broad based improvement in outlook, the prospect of the economy heading into a recession seems increasingly unlikely. Investors are nodding in agreement. This booming market isn't just about the tech gains or the magnificent seven anymore. We're witnessing a concurrent upswing in sectors like transportation and industry. Think everything from trucking companies to manufacturers, which are traditionally seen as important signs for where the economy is headed. These sectors have been trusted economic thermometers for over 100 years. So when these areas are doing well, it's a good sign for both our economy and the stock market. By now, it's pretty clear that the 2022 bear market, the time when stock prices were falling, is in our rear view mirror. Looking back, it appears to have been what experts call a non-recessionary bear market. This means that, despite falling stock prices, we didn't fall into a full-blown recession. Keep in mind, though, this doesn't rule out the possibility of a recessionary bear market cropping up in the future. Let's review some key insights from recent economic data. US stocks are looking pricier than usual, both in terms of history and compared to bonds. Some risk indicators, like high amounts of speculative call option buying, are flashing warning signs. Also, stocks related to extreme weather have been doing notably well. Plus, there are now half as many publicly traded companies as there were 20 years ago. Could this mean a shortage of stocks on the horizon? Considering these factors, it can be concluded that a blind optimist in the stock market at the moment carries higher risks. Thanks for taking the time to view, and if you have any questions, please let me know.